Please note that the information on Retire Vivid referenced in this video is accurate as of May 16th, 2025. Changes to laws and regulations may make portions of this segment outdated and no longer relevant. Information presented is for educational purposes only and is not intended to provide investment, tax, or legal advice. Please see our full disclosure at the end of this video.
Welcome to Retire Vivid. I'm McCarty. That's Breitbach. And today's episode is on taxes. More specifically, we're going to be talking about a number of things. The first is going to be how do you save efficiently? We're looking at investing efficiently and also distributing those assets from a tax smart perspective. I mean, Tommy, this should be a pretty good one today.
Yeah, we've had prior episodes kind of more focused on that distribution phase, or how do you withdraw assets tax efficiently. But taxes play a role, from the very first time you start saving until you start spending that money.
Right.
And so how do we do all of the different pieces efficiently?
Well, I think our viewers that have been watching us for some time, I think they're starting to see that taxes play such an important role, just like you mentioned, when it comes to all aspects of financial planning. And so once we're diving into this, and so I want to talk more about this, but let's dial into save efficiently, right, from a tax perspective. With the first thing we got to do, we got to identify your tax buckets.
You have a pre-tax and may have that after-tax or Roth option within
Roth,
those.
yep.
Yeah, so your pre-tax, you take a deduction now, gross tax-free. When you withdraw it later, it's 100% reportable as taxable income.
Well, and one thing we're going to do is we're going to be giving different scenarios, but that's part of the deal. I think with a lot of our clients, they're retired or close to retirement. That's what they were taught, right? Because one thing we got to look at is their future tax landscape, because, they're taught, hey, I'm going to be in a higher tax bracket while I'm working. So feed those pre-tax accounts, get that tax deduction like you mentioned, and then they're taught when you retire, you're supposed to drop. But that doesn't happen all the time, does it?
Depending where the income levels are, it's not always that you're going to be in a lower tax bracket or a significantly lower tax bracket to overcome those benefits.
Yep.
So the after-tax portion, the Roth, that came along later.
That's right.
So that money you do not get the deduction up front, gross tax-free. If it's a qualified distribution, comes out tax-free.
Unless you hit those rules. We did an episode on the Roth IRA when it comes to the 5-year rule. We're not going to get in that today, right?
Yes, but be wary of the Roth, the qualified distributions, the 5-year rules that make those qualified.
Okay, and also the brokerage account.
And then you have the non-tax qualified assets. So that could be your individual, your joint, maybe you hold a trust account, kind of like your bank account. But that has tax implications in the year that activities happen. So you have dividends, interest, gains, short-term, long-term, but those are taxed in the year they happen. And then that last one is sometimes underutilized, and that's that HSA account.
Yeah, that's a good point.
It, from a retirement perspective, can be a great benefit. It can be triple tax-free if you use for qualified medical expenses. So a deduction, gross tax-free, comes out tax-free for qualified medical expenses.
I'm glad you brought that up, because you're right. It's a wonderful tool, but that's the whole point of this episode. We're talking about tax efficiency. And so the first is, in terms of where you can put that money, I think the big question that people have for us, Tommy, is, okay, I kind of already addressed the tax landscape, right, in terms of where are we at. And all of our viewers that are listening, they're all across the board in terms of where they're at, in terms of are they at their peak earning years, whatever it may be. So once we know where their current tax rates are, in terms of their marginal tax rates, I want to talk about some scenarios, meaning the question is do you look at Roth IRAs or do you look at traditional IRAs in terms of what scenario should you be making those contributions?
It's really important to evaluate the intent of those assets.
Right.
So from a retirement planning perspective, it's most often in the traditional or the Roth. Mm-hmm. The non-qualified tends to come after that. Or if there's a plan to use those funds prior to retirement or prior to 59 and a half where there's no penalty. Mm-hmm. And so from a traditional or Roth, you want to evaluate, I'll say the two T's, time and taxes.
Okay,
but,
that's good.
where are you at? How long do you have? And what is your current versus projected tax landscape?
Just quickly, let's go through some different profiles here and then talk about what likely benefits in terms of a Roth or traditional. Let's do that. How's that sound? So the first one is a young person. They're in a lower tax bracket, but maybe looking at going into a higher tax bracket later on. Their income is $55,000 and they're single and they're in the marginal rate of 12. Which one do you think would benefit them?
So from a tax perspective, the first T, lower tax bracket, looking at a long time to invest and save. So that tends to benefit a Roth contribution.
Right, which makes sense because then we go from the 12% tax bracket up to the 12. Our viewers know this. I mean, we talk a lot about tax brackets, helping them manage the brackets in terms of bracket bumping, that sort of thing. Okay, now let's talk about somebody that has maybe a larger traditional IRA or a 401k and wants to minimize, and we've done an episode on this, they want to minimize required minimum distributions. And their income in this case, Tommy, $160,000.
Yeah, so it tends to be, as you get closer to retirement, you have an idea of what your income needs are, what your account balances can provide from an income perspective. And so for someone who's looking ahead to RMDs, thinking, they may not spend their current traditional balance, they can benefit from making those Roth contributions, building that, that future tax-free asset.
Well, and so looking at the situation with this example, right? So in this example, they're approaching retirement. They got $3.2 million in 401ks. Their RMD is going to be around, $181,000 at age 83. Plus, they got Social Security. I mean, they could potentially bump into those higher tax brackets. So again, which would they likely benefit from?
They're currently paying 22. They may go to the 24,
right?
Based on the assumptions in that example. They're going to be paying a higher tax rate later. So taking that money out from the traditional later is a higher tax rate than taking the deduction into the Roth now.
Yeah, so the Roth would make sense in that case. Potentially look at Roth conversions. Okay, next, let's jump down to this one. So we have a person who is in their peak earning years that could potentially go into a lower tax bracket. Remember that example I said we're all taught because you're in a higher tax bracket when you're working and then you retire. So here they have a $450,000 income. They're in the 32% tax bracket, but they're currently near the bottom of the tier. So what makes sense for them?
When you're looking at the ordinary income tax rates, you have your 10 and 12 bunched, you have your 22 and 24 bunched, and then you go up into the 30s. And so there's a gap from 12 to 22, a gap from 24 to 32. Those are larger, than your 2% jumps. And so if you're able to take that deduction in that 32% bracket, looking at maybe taking it out later in the 22 or 24, take your tax savings now, that's a traditional contribution. Take it out of the lower tax bracket later.
This is kind of fun to show people because we do get that question asked quite a bit. Which one should I invest in? Or in terms of a bucket that I should be looking at, it's not always the case where it's the Roth. I mean, that's the story here. Okay, well, let's take a little break. We got a lot more to go through here. So next, we're going to be talking about the do's and don'ts when it comes to taxes. We're also going to talk about becoming tax efficient with your portfolio. More right after the break.
Do you have questions about your retirement plan, or do you want to know if you are on the right track? We are here to help. Simply go to retirevivid.com or call the number below to schedule a 15-minute retirement review. You can speak with us about taxes, Social Security, your 401k, or any quick retirement questions at no cost to you. We are here to make retirement vivid. Schedule your 15-minute retirement review today.
Welcome back. Okay, so we're talking about becoming tax efficient. And one of the things that we hit on was the first, I broke it up at the beginning, talk about tax saving. Now we're going to talk about investing from a tax smart perspective in terms of being efficient. I mean, Tommy, obviously we're not going to talk about what individual securities. We're going to talk about the different types of buckets in terms of where you can put those investments.
When you're investing, you have tons of options. Most commonly people think of a bond and a stock mix. Mm-hmm. Most people have in their mind like a 60-40 type mix. But it's not just what you select, it's kind of where you put those different investment types. And so you have broad categories. You have municipal bonds. They tend to pay federally tax-free interest. If they're issued in your state, they're state-free or state tax-free as well.
Yeah.
Then you have...
Well, real quick here, I want to jump in. I mean, the one thing about the taxes exempt interest that a lot of people don't know, since we're talking taxes today, is it does cause your Social Security to become taxable.
Falls in there.
It falls in there.
That's a nice little tidbit.
Well, a little plug, a little plug. Just, but the Roth doesn't. All right, keep going.
All right, then you have your bonds. They pay bonds, money markets, those type of things, pay interest or ordinary income taxed at your marginal tax rate.
Right.
Then you have stocks. U.S. stocks specifically tend to pay qualified dividends. And then from there, when you buy and sell stuff, you have gains. Mm-hmm. So you have both short-term and long-term gains, typically, held less than or more than a year.
Yep.
But it's really important to evaluate what you're going to hold and also where you put it from a tax perspective.
Yeah, that's a good point. I mean, we'll talk about asset location here in a minute, but the one big one that, especially with what a lot of people are in, would be the difference between an exchange traded fund or an ETF versus a mutual fund. I mean, again, we're talking taxes today. There are differences when it comes to these two.
You can find the exchange traded fund, the ETFs or the mutual funds that try to do the same thing. Comparatively, the ETFs tend to be more tax efficient, and that's through kind of how they are created. They have a creation and redemption process, which is more of an exchange of shares compared to a mutual fund, which tends to have a wrapper, essentially a wrapper around the holdings. Within it, they buy and sell. The tax efficiency comes from the combination of everything that happens in a mutual fund throughout the year. If all of the buys and sells they've done resulted in a gain, they have to push out the capital gain distribution to the holder, regardless of you as the investor have bought or sold anything. They're going to calculate that on the inside and then push that gain distribution out to you.
And I got to tell you, one of the things that drives me nuts about that is, you and I know this. I mean, we do a lot of tax plans for our clients, a lot. And one of the things is if a client has a mutual fund held outside of us, for example, that's the one thing that can just blow up our tax plan because we don't know what's going on. And here's the thing too, they don't care, right? I mean, they're still going to distribute that to that client, and we really don't know until the time comes. And then that's where those unknowns come and go, whoa, what happened? I thought we had a good plan here. Well, this mutual fund just did something. Where an exchange traded fund, it's just like you said. I mean, it could significantly have fewer capital gains in terms of being distributed to shareholders. So an ETF can certainly be extremely tax efficient.
Most of those mutual fund cap gain distributions come out in December, and so it really limits your window from a tax planning perspective. If you wanted to do a Roth conversion, or you're looking at IRMA brackets earlier in the year, you come into December, that distribution can, change the entire tax plan.
Oh, absolutely. Now I want to move on. I want to talk about this and drive this point home in terms of how ETFs have consistently distributed fewer capital gains over time than mutual funds. Tommy, walk our viewers through this. I mean, don't go deep into this. It's just showing from the years 2014 to 2023 in terms of the weighted average of percent that has been distributed in terms of capital gains.
Yeah, and this is a JP Morgan example using Morningstar data.
Yep.
But you can see they have 4 different categories. They have passive ETFs, they tend to track index. Active ETFs, they may buy and sell different things just depending on the manager's performance. Same thing for mutual funds, passive mutual funds and active mutual funds.
Yep.
And you can see, based upon the amount of activity in the product type, specifically active mutual funds, they pay a much higher percent as a capital gain distribution. Yeah. And you can see it consistently across all the years.
Look at that. I mean, you can see that those distributions, it can cause potential taxable events where, what if it bumped a client into a higher tax bracket, right? I mean, there's a lot of things that we look at. So it's not just the investments that you're in to accomplish the goals in terms of what you're looking for capital appreciation, but it's also how do I become tax smart? You know, it's that old saying, it's not always what you make, but it's also what you keep. And this is a great example. I don't want to beat up mutual funds though. I want to be clear. I want to be clear to our viewers. Mutual funds fit certain people. But from a tax planning perspective, I mean, let's be honest, I'm looking at ETFs.
Right. Well, ETF specifically in a non-qualified account.
Non-qualified assets.
If there's a mutual fund out there that you really like, that's where you have options. If you have your retirement accounts, your pre-tax or Roth compared to that non-qualified asset, that's where asset location comes into play.
Let's talk about that. I mean, because you're building right into that. So this would make sense in ETF for a non-qualified asset. We already talked at the beginning about those buckets. Let's break up asset location now. Great segue. Walk us through it.
When we mentioned those capital gains distributions, you know, they don't apply to, they still process, but they don't apply to your retirement accounts because the taxability of those is just when you take money out.
Right.
And so, you know, in a very simple example, let's say bonds are paying ordinary interest. You're going to have that reported taxable every year. Stocks, if you don't buy or sell anything, tend to not have any gains. And then, you know, long-term gains, qualified dividends are taxed at a lower marginal rate than your income.
Right.
And so in a very general example, you may have your bonds in your retirement accounts because there's a wrapper around it. Right. And then stocks in your non-qualified account. For those, if assets are split, you know, you could be looking at, you know, 50% of your assets, retirement account bonds, 50% of your assets, non-qualified account stocks. Mm-hmm. Very general example, but that doesn't fit everybody.
It doesn't fit everybody. And so let's just give an example here of, you know, somebody that has $1 million.
Yeah, this example comes out here. Somebody has $1 million, you got $400,000 in a traditional pre-tax account, $200,000 tax-free account being the Roth, $400,000 in a taxable account. You want a 50-50 allocation. You have an option to hold a 50-50 split across each of those accounts, or you can look at asset location and maybe say, hey, I'll hold my bonds in the traditional side, whatever's needed to get that 50-50 split, look at the stocks and bonds in the Roth account, and then look more qualified dividends, long-term cap gains from stocks in the taxable account.
Sure.
And Vanguard run an example, a whole bunch of assumptions in here, the tax rate, the qualified dividend tax rate, but showed that the average annual tax savings can be, you know, minimal to up to 0.33% a year just by being tax efficient with your asset allocation.
Yeah, that's a big deal. And I think our viewers are really wanting to hear this type of information. But this is also why we do that 15-minute retirement review. I mean, this has been so valuable for people. This is where they have the opportunity to, again, ask us these questions. I mean, today we're talking about tax efficiency. So they might want to learn a little bit more about ETFs versus mutual funds, or maybe Social Security, or Tommy, retirement in general.
I mean, we say if there's easy questions, they can be answered a lot of times in that phone call.
Yeah, and so we do encourage everybody to take advantage of that. Okay, so next we're going to be moving on to distributing assets from a tax efficient level. Stay with us, more after the break. Okay, welcome back. So let's start with a little do's and don'ts when it comes to tax planning, and then after that, we'll close up with a couple examples. Okay, the first do, well, we already talked about it. You need to know the different types of income in terms of how they're taxed, right? We got to know.
Yeah, if you need the answer to that, go back to segment B.
So if you missed it, I guess you better go back.
There you go.
You better go back. Okay, how about this one? A don't. Don't limit yourself to just one retirement account, right? We talked about all the different buckets.
Yeah, when in doubt, diversify it out. You know, give yourself some options.
I've not heard that one. That was pretty good. And a good reason for that is, you know, we don't want to pop people into a higher tax bracket, right? Makes sense, right? I mean, we call that bracket bumping. Okay, how about another don't? Don't make moves that could put you into a higher tax bracket. For example, people might need a car or they want to go on vacation. Where are you going to pull that money from?
Right, evaluate those options. If you're looking at Roth conversions, if you're looking at IRMA, a lot of tax implications from having that diversified asset base.
Yep. Okay, how about a do? Look ahead before you turn RMD age, in this case, age 73.
Well, you don't necessarily have to, but that RMD is going to happen anyway.
I'm going to give an example why you need to.
The RMD is going to happen anyway. So for those that are planners, look out to that age. Review your RMD.
How about this one? I like this one here. Don't overlook how long you've owned an investment.
Yeah, those non-qualified accounts. We talked about the qualified dividends and the long-term capital gains tax rate. You get a tax preference on those.
You do.
There's no sense selling something 11 months in if you can hold it another month to get to that long-term preferential rate.
Absolutely. And a do, always review your tax situation, especially when you have life changes. What's a life change? You get married. A life change. You lost a spouse, right? Your tax situation changes. You need to be looking at those when something comes up or when you retire.
Yeah, when you're planning to retire, when you get a new job, when you lose a job. I mean, tons of life examples, but keep taxes in the back of your mind.
Well, the point is to work with a professional. I mean, work with somebody that does this right for a living. So, okay, now let's move on. So let's wrap up here with a couple examples. I want you to go first because we talk about for people that need money when it comes to retirement. The question that usually comes, Tommy, is, okay, should I pull all from one bucket? Meaning like a traditional IRA or a Roth? Do you do it proportionally? What should people be looking at?
You've spent all these years saving, accumulating assets. How do we use them tax efficiently? So real quick example here, individual 62 years old, filing single, needs $60,000 after tax income, has $25,000 of Social Security benefit. Assets are growing at a 5% rate of return. He has $200,000 in the taxable bucket, the non-qualified. $250,000 in a pre-tax account, $50,000 after tax. So as he's looking at using those, do you withdraw sequentially? So take all of your taxable and then your tax deferred and then your tax free. Take them in order, or do you do proportionally across the way?
Right.
And so in this example, you can see withdrawing one at a time, you can see that tax bump in the middle when he starts to hit that tax deferred or traditional IRA account. You see that tax bump in the middle. Withdrawing proportionally allows him to manage his brackets based on his income need. And so you pay a little bit of taxes every year, but over the lifetime, you can see he saves almost 40% in taxes.
40% in tax savings.
So withdrawing
huge.
sequentially right there, he's over $57,000 in estimated taxes over the lifetime compared to $35,000 when he evaluated it and withdrew proportionally.
This is the stuff we're looking for. I mean, by identifying those buckets and then building that plan out. Because what do we want to do? We want to help people save money in taxes. I mean, don't get me wrong. I mean, I don't mind paying taxes. But I just don't want to pay any more than I have to. And I think a lot of our clients can attest to that.
Well, it's just kind of the difference between planning versus not planning.
Yep.
For those that want to plan, look proactively, you have options.
Okay.
Because your RMDs, your income need, all those things are going to happen. Just those that want to be proactive have options.
They have options. Okay, that's a great segue for another example when it comes to required minimum distribution. So take a look at this. So here we got a married couple. They're both age 59 and a half. They're married, filing jointly in terms of their tax status. They got $275,000 coming in. They have $2.5 million of tax deferred. We've talked about that. This is IRA 401k assets that's subject to the required minimum distribution, and it's growing at 6% a year. So in this example, look at this, Tommy. This is them doing no planning, meaning no conversions, nothing. They just wait until that tax bomb hits, and look when it does. Not only did they fill up the 24% tax bracket, they went 2 tiers above that because they were good planners, they were good savers. That's a big deal.
It is a big deal, and especially when you're looking at tax rates, you have the gap between 12 and 22, and then you have the gap between 24 and 32.
Yeah.
The other ones are kind of bunched. So if you have the option, review where you're going to be from a tax perspective in the future.
Absolutely, that's that tax landscape. And don't get me wrong, this is a great problem to have. I mean, it's not like it's a bad thing. But again, it's how do I save money in taxes? So let's dive ahead. What if we did some Roth conversions, right? We were proactive. We were pre-planning. We were working with somebody that's done this before. Look at this example. So here they were doing Roth conversions, filling up the bucket, filling up the tax bracket, right? We don't want to do any more and pop them into the next tax tier. Our goal is what is that number, and you convert the difference, and look what you just did for when those RMDs hit.
You know, it is putting everything together. How we talked about asset location.
Yep.
We talked about mutual fund versus ETF tax efficiency. We talked about pre-tax, Roth, non-qualified assets. How do you put everything together? Just put a little bow on it.
Yep.
But proactive planning for where you may be in the future.
Absolutely. And so this is where we encourage people to go to our YouTube channel. Go to Retire Vivid. We've got so many different episodes walking through the Roth IRAs. We talk about retirement in general. We do one just on Social Security. I encourage everybody to take a look at all those videos. We're here to help them through it.
Yeah, taxes are one piece of all of the other items you have to plan for in retirement. And so if there's questions on, you mentioned Social Security, taxes, estate planning,
yep,
investing. All those options or all those resources are available out on the Retire Vivid channel.
All right. Well, we're out of time, folks. Hopefully it's not as clear as mud, right? We went through quite a bit. But again, we're here to help you. That's what this show is all about. And so again, thank you for watching. Thank you for making this show possible. And be sure to DVR Retire Vivid so you never, ever miss an episode of our show, as we're here to help you through all aspects of retirement planning. We'll catch you next week right here on Retire Vivid.
McCarty and Tommy Breitbach are investment advisor representatives of Vivid Wealth Management, a SEC-registered investment advisor located in Des Moines, Iowa. Investment advisory services are offered through Vivid Wealth Management, LLC. Insurance products and services are offered through Vivid Tax and Wealth Advisors and individually licensed and appointed agents. Tax planning and preparation services are offered through Vivid Tax Center, LLC. The preceding entities are affiliated. All statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Case studies and examples presented are hypothetical and used to demonstrate a concept. These studies do not represent actual clients or results. Similar or even positive results cannot be guaranteed. None of the entities above are affiliated or endorsed by the Social Security Administration or any government agency. Information expressed does not take into account your specific situation or objectives and is not intended to provide investment, tax, or legal advice. Viewers are encouraged to seek advice from a qualified attorney, insurance agent, tax or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance. Investments involve risk and, unless otherwise stated, are not guaranteed.